Hey guys, welcome. Thanks so much for joining us today. We are here to give you a quick summary of the new OBBBA. We're still internally having some conflict over what to call it, whether we're going to call it OBBB or OBBA. So we would love to hear from you guys what you think we should call it. So please send us your submissions and we'll take it into consideration. So again, we're going to make some quick introductions and just dive right in. If you guys have any questions, please feel free to send them over. There will be an email. I think it's OBBA at saltmarshaadvisors.com. But again, if you guys have any questions, feel free to send them and we'll hit them at the end. So I have the pleasure of being here with my partners, Mike Cole and Stacey Craig, and we have all taken a pretty quick crash course on this subject. And I'm sure you guys are aware there have been several iterations and there is a lot of information out there. Depending on which source you use, it may or may not be the same information that you get. So we're going to try to slice and dice that for you today here. We've themed our presentation the MythBusters edition because like we said, there is a lot of misinformation out there. So if you use ChatGPT to find your information, you may get something different than if you use Gemini, or if you so chose to read the 800 plus bill, then maybe you should be doing this webinar. So thanks again for joining us, and let's begin. Today is, of course, to get you guys more informed on what's actually happening. So myth number one, the OBBB does not benefit all income levels. We have heard this all, and so we're going to break this myth today. Stacey, I will pass it to you.
Yeah, thanks, Suzanne. So, a lot of the information that's out there is about a lot of the business tax law changes. And so there are some items on here that a lot of people have heard about, and we just want to make sure you're aware of those, what actually ended up in the final bill. So the first item we have on here is that they have eliminated the tax on tips. And so what does that mean? And so this is a temporary change impacting 2025 through 2028. And this is tax on tips that are voluntary and customary. And the IRS is supposed to be issuing a list of what type of industries that this will impact. So don't go out and change your whole business structure to make the majority of your revenue tip-based instead of your regular fees.
I've already had clients asking me how to change their entire business in order to have tip income. So that is not going to be allowable.
Exactly. And so this is going to be an above the line deduction. So there's probably going to be some payroll reporting that's going to happen in order to give employees what that number is so that they can report that on their tax returns. It's maxed out a limit of $25,000 deduction. And again, this is something that's temporary. There's also a income limitation that if your modified AGI is over 150,000 for single or 300,000 for married filing joint, that you won't get this benefit. So this is aimed at trying to get some of those lower income households to get benefit of this. Similarly, we have an exception for overtime pay. So you've been hearing, overtime pay is now not taxable. But what does that really mean? So it's actually a temporary law as well from 2025 to 2028. And it is only on the differential of your overtime rate. So if your ordinary rate is $10 and your overtime rate is $15, the overtime that is exempt is only the $5 an hour of your overtime. There's also been discussions about what if you have a shift pay differential. Are those things considered overtime? And that is not considered overtime. The overtime is typically what is worked over a 40-hour work week. So again, there should be additional information coming out from the IRS on that. There's also some questions out there about exempt versus non-exempt employees. And if you have exempt employees that are getting overtime because of how you've structured it, is that going to qualify? It looks like that is not going to qualify either. So again, this is trying to be geared towards those taxpayers that have normal overtime type structures. Another item that we have come across that is new in this bill is a auto loan interest deduction. So again, this is another temporary 2025 to 2028 deduction. It's an above the line deduction up to $10,000 of your auto loan interest. The indebtedness had to have been incurred in 2025 or later, and it is on a new vehicle. So you must be the original user of that automobile. The regulations also state that if you have refinanced indebtedness, that would also qualify. But again, there are some pretty detailed requirements on that. So we would just recommend that you reach out to us if you're trying to utilize this deduction to make sure that you can deduct it. One of the other requirements on that is that the final assembly has to be in the US. So this is something that your dealership is going to have that information available for you to be able to know if you qualify for the deduction. And we're anticipating that there are going to be some regulatory requirements on what information you need to provide with your tax return to get that deduction. Lastly, we have here is a senior deduction. And so in the OBBBA bill, as I like to call it, they have tried to help some of our seniors that are receiving Social Security benefits. So they did not make Social Security benefits completely non-taxable, but instead they have given seniors that are 65 and older receiving Social Security benefits a $6,000 above the line deduction, again, subject to certain income limitations to try to offset some of the taxability of those Social Security benefits.
And if you're like my father, he thinks he's supposed to get a check. So check in with your seniors, make sure they understand exactly what this means.
Yes, exactly. In addition, there were some other laws that were temporary from the previous tax law bill, the TCJA. Those have now been made permanent. So there is the child tax credit, which was $2,000 and scheduled to decrease to $1,000. That is now set at $2,200 and will increase with inflation adjustments. In addition, the TCJA had doubled our standard deduction, and that is now a permanent change. So the standard deduction will be around $15,000 for single, $30,000 for married filing jointly going forward. So the reality in this is there are opportunities for tax savings for individual taxpayers and not just the corporate business law changes. So we feel like this myth has been busted.
That's right. If you don't agree, send us an email. All right. Myth number 2, I do not need estate planning. So I'm sure you've heard that the exemption is, going away. And so there's been a lot of discussion over, well, I don't really have to do anything now because it's not a big deal. So I think, Stacy, you're hitting this one also.
Right. Yeah. There's a lot of discussion out there, and there is a lot of planning on, do we need to do planning? Do we need to wait until the end of 2025 to do planning to see if the tax law changes? Because if the tax law if this is made permanent, then I'm not going to do anything. And the reality is that this is the danger of false security, that I don't need to do anything. I can worry about it later. Yes, they have made a permanent increase to that lifetime exemption. So it will be $15 million per individual starting in 2026. However, permanent, like everything with the government, is not necessarily permanent. We could get a new Congress in, they could make changes down the road. But there's also other reasons to do estate planning that are not tax objective focus. So things like avoiding probate, your asset protection, succession planning, if you have any charitable or philanthropic goals, these are all still reasons to have that conversation with your estate attorney, with your accountant, making sure that we're all on the same page so that your wishes are fulfilled when you pass away. So just because we have a change in the lifetime exemption, and that's now a permanent increased lifetime exemption, don't ghost your estate planners and your accountants when we're trying to talk to you about trust and estate planning.
Stacy, that's a really great point. And one area that I think we oftentimes forget, because we so often focus on the federal, because that's oftentimes the major impact, is also a lot of the state and local states. I don't know of any local estate tax, but there are a lot of states that have different rules. And like myself, I moved down during COVID to Florida from Minnesota, and the estate rules are different here than they were where I used to be. So sometimes whenever we have a new bill or we're thinking about the changes, it's not just about what's going to happen at the federal level. It also applies to what's happening at the state level or what happened with me personally, right? So just because the big, beautiful bill or the one OBBBA didn't necessarily impact you in a negative fashion, doesn't mean that there aren't other planning aspects like you were talking about that really need to be considered.
Absolutely. Yes, and we have a little video here to help drive home the point.
2, 1.
Okay, so essentially we're saying myth number 2 is busted, yeah?
Yes, absolutely.
All right, moving on then to myth number 3. So myth number 3 is my tax won't change. So obviously the initial perception is the OBBBA makes the tax cuts and jobs at the federal income tax bracket schedule permanent. So Stacy, talk to us a little bit about that. That's a tongue twister.
Yes, absolutely it is. So, they have now made the temporary rates from the TCJA permanent. And so it's like, okay, well, what do I need to do? Like the rates are staying the same. So if my income's the same, my deductions are the same, then my tax should be the same. However, they did a little bit of changes around the itemized deductions that we just want to make you aware of. So if you remember back in the day, there was a piece limitation on itemized deductions that was basically a haircut for high income earners on their itemized deductions. They have eliminated that. However, they have now implemented a new cap on itemized deductions. So the maximum benefit that you can get on your itemized deductions is 35 cents on a dollar, meaning those taxpayers in the 37% bracket will only receive 35 cents per dollar benefit from their itemized deductions rather than 37 cents on the dollar that they would have normally received. In addition, they've also created a 0.5% floor for charitable deductions. So if you make an AGI of $100,000, $500 of your charitable deductions would be non-deductible because of this new floor that they've implemented. And lastly, they have increased the SALT deduction from $10,000 to $40,000. However, there is a phase out on that. So taxpayers that make between $500,000 and $600,000, that $40,000 cap will go down, but not below $10,000 that it was before. So again, these are some additional items that You'll want to talk to us or your tax advisors about how do we implement this? What kind of planning do we need to work around these items? Mike?
Yeah, so I think as you're thinking about this, Stacy, right? So many of the people we work with have their own businesses that they own, right? And so a lot of the work that we do actually in the last few years has related to what's referred to as the PTET election, right? Which lets you
Correct.
pay the tax for the state and local taxes at the entity level rather than at the individual level. Also, oftentimes we used to be very, I'll say, laissez-faire about whether or not a deduction should appear on a Schedule C or on a Schedule A, such as, interest relating to use of a real property for that's both used as a home and as a part of a business. If you're somebody that kind of works your own business out of your home, we've oftentimes kind of figured out where the best place is for that interest deduction to arise. Now that this gets a lot more interesting as we think about this 35-cent limitation on on every dollar of itemized deduction, and also how state and local taxes are going to impact each individual, there needs to be some real thought and consideration as to what positions have been taken in the past versus what positions are appropriate kind of on the go forward, and what facts kind of support both sides of the argument. I think that this area right here is going to be one that's going to sneak up on a lot of people as we go into Q4 planning, because I know that our software and no software I know of actually has implemented the OBBBA, OBBA, whatever we're referring to it as, yet for 2025 estimates. And this is an area where I could really see some people getting caught off guard that their payments just weren't enough.
Right. Yeah, I completely agree. And I think this is also another area where multi-year tax planning is really going to be important to look at. Not only what do you have going on for 25, but what do you have going on for the next few years, that we can start making some educated, intelligent decisions on that planning for our clients. So, all in all, what we see with this is that for this myth, we really need more data, because depending on what your situation is, we really need to kind of dig down into the individual's tax situation to determine if their tax is going to change and how it will change because of this bill.
Yeah, so tax planning is going to be really important because as we're saying over 3 years, if your income is set to fluctuate greatly, that could affect you as well in the phase out and things like that. So we need more data to really be able to say if your tax won't change or not. So that's what we're stamping this one as. All right, moving on to myth number 4. The OBBBA repeals all corporate tax compliance requirements. So we have heard this a lot, that there will be just zero tax compliance needs for, corporations. They are just going to get away with everything tax-free. And so we're going to discuss that a little bit and see if we agree.
Yeah, absolutely. So, one of the things that always makes me laugh is that they say, like, we're simplifying the tax code. And, this is a over 800 page tax bill. And I don't think they simplified much of anything. And
yeah, how can you simplify anything at 800 pages? I'm not
right.
sure.
Exactly. And so I think, when we look at the corporate tax compliance requirements, we're not seeing anything in this bill that really removed anything that corporate taxpayers have to report on. So, for example, the R&D credit information that we're going to go into in a little bit more detail in a moment, there is a lot of detailed tracking that needs to happen, and those tax forms have actually gotten more robust rather than being more simplified. In addition, a lot of people were talking about the employee retention tax credit and how there was so much fraud going on with that, and that it was just a corporate handout. Well, this bill is extending the statute of limitations to 6 years for the IRS to come in and really dig deep into these different companies and making sure that that money actually went for what it was supposed to go to. So I think this is one area where the OBBA really made it like harder on corporate taxpayers.
Yeah, because like you said, it's extending the period at which the IRS can audit you. So that's benefiting the IRS, to make sure that they have time to catch anybody that may have fraudulently filed a return. And so it eliminates that concern of a lot of people that like, oh, this company or whatever took this illegally or fraudulently. This gives the IRS a extended period of time to look into those claims and find out if those claims were actually fraud or not. And like Stacy said, we're going to talk about R&D in a minute, but there's actually more compliance that we see really required than less compliance.
Yeah, absolutely. So I think we can call this busted.
I was going to say, I think it's busted. What do you think, Cole?
Yeah, absolutely. When we have as many changes as we have now as we had in 1986, there's no way anything got simplified.
Cole was like 5.
I was 2.
Oh God. Okay, 2. Sorry for those of you in the audience. Cole is younger than me, so I like to poke fun at him. All right, we are moving on then to our next slide, which is myth number 5. The OBBBA guts energy incentives. And so we have a lot of clients in energy. We have a lot of clients in solar. We have a lot of clients taking credits for solar and energy related efficiencies. And so we really wanted to dive into this one and make sure we understood, what was going on. So we had heard, hey, they're just getting gutted. So what's the scoop, Mike? Tell us what's actually happening.
Yeah, unfortunately, the energy incentives relating to production of clean energy has really been removed and shortened. And I think when we talk about it being gutted, what we're really talking about is that there was a lot of plans and a lot of credits and incentives that were set to expire at the end of 2026 that are now expiring as soon as the next 30 days, right? And so as we think about it, things like the previously owned clean vehicle credit, we used to take a credit for buying, a rechargeable car, an electric car, that was scheduled to go out through, I believe, the end of next year. That's now done as of September 30th of this year. So as we think about this budgetary act, right, and this OBBBA, they almost have to pay for themselves, right? And so as we think about how there's incentives given on one side, there's also got to be things taken away on the other side. And unfortunately, clean energy seems to be the one that got kind of caught in the crosshairs to have a lot of things eliminated. And so, things like the clean vehicle credit, that again also expires on September 30th of 2025. That previously existed and had a lot longer of a runway. The investment tax credit, anybody that's invested in solar farms or thinking of investing in solar farms, that still goes out theoretically for clean hydrogen until January of 2028. For solar and wind, it theoretically can be good until December of 2027, but all those construction projects kind of need to be placed in service within what's essentially now 45 days or 60 days of when the bill was signed. This can be a real daunting task for a lot of our contracts, or for a lot of companies that have contracts to get projects done or started before the end of the year. Well, now they really only have 60 days to get caught into a safe harbor. Another area that kind of really kind of caused some problems relates to what's referred to as energy efficiency for a lot of our business owners. 179D is now scheduled to expire on June of 2026. The good news is, though, that clean energy storage, so let's say you're a part of a production facility that's kind of generating energy, things relating to putting in batteries and other things to help neutralize and offset kind of peaks and valleys within our energy grid, which really puts a lot of wear and tear in planning. Those still are in existence and those continue on as regularly scheduled. But unfortunately, a lot of the rest of the credits and incentives, whether it be for homes, production, or use in energy efficiency of a commercial or residential building, they've all either been shortened or eliminated, which kind of is, sad to see. But again, as one thing kind of gets a benefit, another thing kind of gets a detriment.
So if you buy a car by September 30th, that's okay. You'll be able to take the credit on your 2025 return. You just can't buy it after.
Yes, and so that's where it gets interesting because you also need the reporting information from the dealer from whom you bought it to ensure that you're going to have a qualified car. So, like anything in the tax world, it's not just like, yes, do it by this day and you're good to go. There's 19 double little I's that you need to go through to figure out if your car qualifies.
Yeah, we've definitely had that with some clients. They've got to go back to the dealer and try to get copies of things. So if you are taking advantage of this, do it quickly and make sure you have the documents. So it sounds like listening to you guys that this one's true, yeah?
Yeah.
All right.
Yeah.
Well, we're going to stamp this one true then. All right, moving on to myth number 6. So we've heard that R&E and 199A have been made permanent. So what do we have to say about that, Cole?
So that is probably one of my favorite parts about this new bill, other than opportunity zones, is that we've really seen an expansion of the 199 Cap A, which for a lot of our manufacturing and small business owners really has made a huge and ginormous impact for them. That's the 199 Cap A is the section that allows our S corporations and partnerships in most lines of business to be able to take a deduction of their revenue against kind of their ordinary line one operations and help them to compete against C corporations. Because if you're a pass-through entity, historically, you've been at a rate detriment compared to C corporations that are being taxed at 20%. We see this impact a lot of our small businesses and get their rates down to about 22, 23%, which is much more competitive with C corporations of similar revenue streams than previously. And so 199A's expansion being made permanent really allows for a lot of long-term planning and structuring and utilizing those partnerships and S corporations as a part of family business and small-owned enterprises.
Yeah, because I know a lot of
Additionally,
times we're like, hey, is this even going to continue? When people ask us a lot, should I be a C corp or should I be a pass-through entity? This is one of those considerations that we always have to think about, but we don't really know what the long-term effect were. So, with no expiration or it being made permanent, that's going to make tax planning and structuring a lot more, concrete, I guess, is this the right thing to do?
right, because it's going to take away a timing concern, right? Because right
Right.
now, to your point, Suzanne, we've always been like, all right, so you elected us this year, or you were a partnership as of this year, but with 199A going away, does that mean that you still need to be? That consideration is no longer there. So other considerations like investments from foreign entity and how that gets reported at the individual level, foreign tax credits, PTAT, taxes at state and local levels, those are all continue to be tax considerations for the type of structure you should be. But at the same time, it kind of eliminates this federal concern on a go-forward basis, at
Yeah.
least as long as these rates stay where they're at. Which again, this goes back to one of the slides that Stacey presented earlier, where all the state rates the federal rates were also made permanent from the TCJA. So again, we have that rate consistency now, kind of on a go-forward basis. The other thing to consider is 174, which is often called R&D or R&E, depending upon how old you are. I will forever refer to it as R&D.
Same.
And so we had a lot of clients that had to go back and file amended tax returns or to file what's referred to as change of accounting methods because they do a lot of both domestic and foreign R&E expenses. This includes everything from the development of a new product to also software development. And one of the great things that we saw expanded here for a lot of our business clients is that you can actually go back to 2022, amend your tax returns to be able to take the deductions, or you can kind of do it as a prospective and take an deduction all in 2025 for the R&E expenses that you've experienced over the last few years. This is going to be one of those ones that's going to be a time value of money consideration. Was there a year where you had a lot of income and now you're expecting loss in the future? So is it worth it to pay to go back and amend your returns for the corrections that to kind of go back and take deductions? Is it more beneficial to kind of generate the deduction now and carry forward potentially NOLs limited to 80% of your taxable income to the future? So while this is a great change, it's also one of those changes that's actually going to kind of cost money to figure out what's beneficial to a lot of clients, which is something that I dislike. I like when we have what's referred to as consistency of law, which is it's going to be effective as of this date, so plan for it going forward. As we get into kind of these retroactive things, yes, it's great that there's some flexibility that's being added into it, but the question becomes is, who bears that cost of figuring out going back and amending? Is it the taxpayer? Should it be the government to kind of fix a problem with the law that was created between gaps in administration?
Yeah, that's something we always hate to do is say, hey, client, we would love to get you this deduction, but we have to amend your tax return, which involves, a lot of work and time, and we have to charge you for it. So, your CPA, in order to get some of these things we've talked about today, will maybe have to amend a return, which is going to cost money. So, to Cole's point, we hate that, but it is, it does have to be done. And so that planning consideration comes into play. Does it make sense? So that's something you want to have your CPA look at.
I think
Especially when
another
you,
consideration is, the IRS, like they still have to come out and tell us, like, how do you want us to present this to you? A lot of their workforce has been cut. So if they get flooded and inundated with amended tax returns,
Right.
they were saying that it was taking up to 16 plus weeks to process an amended tax return before OBBBA. So what is it going to mean for all of
Yeah.
these amended tax returns to come in? How long is it going to take for the IRS to actually process that to get the money back in the taxpayers' pocket? So we're really trying to look to the IRS to tell us, is there going to be a streamlined processing for this? Is there going to be another 3115 required for this? Is there going to be additional disclosure required for this? So that's another one of those items that we want to make sure that all of our clients are aware of, is that there may be some additional reporting requirements because of this change that aren't anticipated right now, because we don't know what the IRS is going to require of us.
yeah, and for me, I do a lot of mergers and acquisitions, and oftentimes R&E expenses are one of those ones where somebody either took a conservative or an aggressive position on over the last few years, and it came up in due diligence as to how it is that we're treating these items. I've got one client where they actually had a reserve set aside for R&E expenses. Well, now that client can go back and amend their returns, and so now they're actually making a claim for an escrow account for reserve that was previously set aside for the buyer. But now the buyer lost out on some deductions and some income, so it's going to cause some real complications for in the M&A world, especially when you have international and domestic kind of operations related to R&E work.
Yeah, for sure. So overall, I mean, this one seems pretty obvious to me. This one's true. Yeah.
Yeah, this one's true. Stacy?
Yeah, absolutely.
Move on. Myth number 7. Okay, the OBBBA doesn't help rural businesses. Wow, I have definitely heard a lot about this, that it's really for the larger corps, that it's for the city folks, that it really doesn't affect or help or, the agriculture business or, the Midwest or the small towns or the smaller businesses. A lot of mom and pops out there. We serve a lot of them. So, Stacy, I think you're talking about this one. What's going on with that?
Yeah, and I'll let Mike chime in on this as well. But what we're seeing are, a couple of incentives related to agriculture. So for example, if you have farmland, qualified farmland that you sell to a qualified farmer, they're allowing you to take the gain on that over an extended 4-year period of time. In addition, there are some benefits for lenders that are lending money to for real property that is used for agricultural, seafood, fishing purposes. And so there are some benefits coming out that are going to really help this kind of industry be able to get the funds that they need for their operations. In addition, they've now made the opportunity zone permanent. And I know this is one of Mike's areas.
This is one of Mike's areas. Yeah.
He loves talking about this. So I'll turn it over to him, let him tell us what's new on that space.
Yeah, just before we move off of kind of some of the other agricultural incentives, let's not forget that the increase to the gifting and lifetime estate exemption up to $15 million per individual really goes to help a lot of farmers, especially hog farmers and a lot of corn farmers, because so much of their wealth is wrapped up in the land that they have and the equipment relating to kind of the production of meat and other dairy products. That really can be used to transition generational wealth, that as the value of land in historically rural areas has gone up, it's become harder and harder for those farmers to transition that wealth down to the next generation. So that lifetime exemption is probably the most impactful item for a lot of family businesses that have had acres for years on end, and we're trying to figure out how to kind of move those assets around as people start retiring and as kind of some of the older generations fade away. And now we're talking about opportunity zones, which I love. So whenever I think about tax planning, there's always four pillars. There's hard assets, liquid assets, time, and flexibility. Well, what I love about opportunity zones is it kind of takes a liquid gain, and any gain that's a capital gain, including the sale of business property, can qualify you for investments in an opportunity zone. And that allows you to now defer your gain and get a tax-free exit if you hold it for 10 years. And it went from a item that was scheduled to phase out by the end of next year to now repeatedly reincurring and allowing for basis step up with each of the new 10-year iterations of the Internal Revenue Code. And so when we think about opportunity zones, they allow us to take those liquid gains, invest it into a long-term fixed asset that can be very flexible because you can invest it in any qualified location. And this could be done most oftentimes through real estate, but it can also be done for things like server farms and high-tech jobs. There's a lot of interplay between kind of the gains of from dividends related to stock and the ability to now invest in different businesses throughout the United States. It's also kind of what I'll say as a political win, because whatever governors are in charge of the state on each 10-year anniversary get to pick the new opportunity zone for those next 10 years. So even if your location isn't currently in an opportunity zone, those the new locations are going to be picked for 2026. So go call your governor, try and get your location picked up as one of the qualifying locations. So then you might be able to improve your own business. You might be able to acquire a new business or a new piece of property and get that qualified for a long-term deferral of the gain. There are some interplays about when gain has to be recognized, how it gets recognized, and unfortunately, anybody that invested prior to 1/1 of 26 is still under the old rules. But again, there's still a lot of great things happening with opportunity zones, and I think it's going to replace 1031 exchanges as the most popular real estate investment mechanism within the next decade.
You heard it here, folks. So I have yet to do a webinar with Cole where he doesn't sneak in the 4 pillars of tax planning. So I hope you guys were looking alive there. So it sounds like, Cole, what you're saying is that the initial thought that it doesn't help rural businesses, we are saying that is busted.
Absolutely.
Busted. All right. Myth number 8. The OBBBA doesn't help manufacturers. So I know Stacy and I are really passionate about this. We spent a lot of time on this one because we have a lot of manufacturing clients. And so we wanted to make sure that we were advising them on, how this will affect them and what opportunities there were possibly for them or what's going away. And so the initial perception that this is bad, because I think the initial bills talked about adding some incentives and adding some breaks for them. And then, so that was in the initial proposal, but those didn't end up going through. So I think it got a bad rap because it said, they didn't do anything to help them, but there were just some initial things in the proposal that just didn't go through. Am I right, Stacy?
Right. Yeah, absolutely. So, one of the items that Trump talked a lot about was trying to reduce the corporate tax rate even further for U.S. manufacturers. And unfortunately, that didn't make it into
And that was to
the
kind of like
version.
offset the tariffs, right? So he was trying to help them be like, hey, these tariffs are going to hurt you. At least that's what I understand was the logic behind that was like, oh, you're going to get hurt with these tariffs, so let's lower your tax rate. That's kind of what the thought was, yeah?
Exactly. So, that didn't make it into the final version of the bill. So, a lot of people are throwing up their hands and so like, what have you, done for us? What's in this bill to kind of help us? So there are a few new changes that have been implemented. So one of them is this qualified production property. And again, we're kind of all in the early stages of digging into this bill and trying to figure out what exactly are they talking about. But they're essentially saying if you invest in building a new production property after January 19th of 2025, that you can deduct the cost of that building up front. So typically commercial property would be to take that property cost and depreciate it over a 39-year period. Well, now if you have qualified production property, you can expense the cost of the whole thing in the first year. That sounds great. Sounds like a lot of people would go out and build a new building and just be able to write it all off. However, there are a lot of criteria for the qualified production property. So one of the items is that the production is agricultural or chemical related. Another item is that any part of your administration offices don't qualify for part of being part of that production property. So if you're in a situation where you're thinking about buying and building, make sure you reach out to us to figure out, like, is this going to actually qualify for this production property deduction? Again, the IRS is supposed to provide additional information on this as well. So as we get that information, we will get that out to you. In addition to this new qualified production property, the OBBA also made some changes to depreciation. So we have bonus depreciation that we've talked about a lot for the last couple of years, about how it was supposed to eventually phase out. And so it's now at a 40% that you could write off instead of 100% of a tangible asset with a 15-year or less life. Now, bonus depreciation at 100% has been reinstated and made permanent. So if you have those investments in tangible property, there is an opportunity for you to take 100% bonus depreciation, write that off in 1 year instead of over a 5 to 15-year period. In addition, there's also Section 179 expensing, which is also for tangible personal property that you buy for your trade or business. And that's now a $2.5 million of costs that you can expense in the initial year that you purchase the assets. Another change for OBBA is for those manufacturers that have to capitalize part of their interest expense, or they have the limitation on their interest expense, that previously you had to do certain add backs, and now they're saying that you can take that interest expense limitation before your depreciation and amortization. So the income that you're using to determine how much of your interest is limited, it's 30% of your earnings before tax, essentially, instead of being before tax, depreciation, amortization. So a lot of our manufacturers will be able to get to the interest expense, higher interest expense deduction. And lastly, we have now the ability for our manufacturers to stay on a cash basis method of accounting if their gross receipts over the past 3 years are up to $80 million. So previously it was 25 million. It was set to index to 31 million. OBBA has now increased that to $80 million. So what that means for our manufacturers, staying on the cash method of accounting means that you don't pay tax on the dollar of revenue until you actually receive that dollar in. So therefore you can do more planning with what your cash is going to look like and determine what your tax liability is going to be based off of. So if you're at that 25 to 31 million threshold before, now you have a lot longer runway to be able to stay on that cash basis of accounting.
You know, Stacy, I can kind of see the argument that this is not a big help to our manufacturing clients, because as you look at this, all of this is just about timing, right? So if I'm a business owner, I'm going, oh, this is great. It's going to lower my expense in the current year. But now in year 5, we're going to run into the same issue we did as we were kind of losing bonus depreciation over the last couple of years. They're going to be like, oh, I have no new depreciation to offset my tax in the current year. So again, this feels a little bit slimy to me, because all they're really doing is figuring out when people are going to pay tax, not if they'll pay tax. And when we think about some of the real estate incentives around things like opportunity zones, we think about some of the other incentives that we've seen kind of in other industries, especially in the tech industry and silicon production. Those are what I'd refer to as real cash incentives that make it beneficial to kind of enter into an industry scape. This, I think, just kind of lets people be a little bit more flexible from their cash that they need to pay their tax, but they're paying it, whether it's today or tomorrow, they're still paying it.
Yeah, Mike, I think that's a great point. And my counter argument to that would just be, at least we're kicking the can down the road a little bit until
And there's an opportunity to plan,
Right, exactly. Yeah. So we have an opportunity to plan. We have an opportunity to at least defer tax and then see if Congress will do anything else to help our manufacturers. So it gives them a little bit of a longer runway to see what else can be implemented. So it's an opportunity for the manufacturers to contact their legislators and say, hey, we like what you've done here, but let's see what we can do to get more incentives, like you said, that the real estate industry is seeing right now.
Yeah, and I think a lot of the bonus and the 179 affects them the most because they're usually the ones putting in the most amount of equipment. This isn't going to help some of our clients that only buy a few trucks every year, but for our clients that are putting in full new production lines and assembly lines, obviously I think expanding 179 to the higher threshold is helping them. But I mean, of this list, I think the biggest one is the increase in gross receipts. So for manufacturing, they're expending all the cash to make these products and they're not getting paid, till down the road. So at least they can defer paying tax on that, revenue until down the road. To your point, Mike, I think is good, is that it's a timing thing, but they don't have the cash yet, so it at least allows them to defer the tax until they have the cash, So what's consensus? What do we think? Do we think that it doesn't help manufacturing, or do we think that it does?
I'm voting that it does.
I'm voting that it does, but only in the short term, not in the long term.
All right, well then we'll take that as busted, with probably more information to come as we get down the road to see if that, further legislation will change and help them even more. Hopefully it will. All right, so we do have just a couple IRS updates that weren't necessarily talked about a lot in the news, but we wanted to make sure you knew about them. And so, as you know, the IRS has been making a lot of changes in the way that they do business and the way they process our payments and the way that your tax returns are filed. And so we wanted to make sure that you all knew that they are phasing out paper checks. And so that is a big deal, because we still have clients that love to send paper checks, and that will eventually not be acceptable. So when is that actually phasing out? Like, it's not going to be tomorrow, obviously, but what were the dates on that?
Yeah, so, President Trump issued this executive order 14247, and basically said that the Treasury Department needed to figure this out by September 30th of this year. And so the AICPA, who, advocates for CPAs and our clients, has written a letter saying, hey, we need more time to figure this out. There are a lot of people out there that still don't have bank accounts, don't have access to that, and they need time to figure that out. And we need to have a better process of what is it going to look like for the IRS? What are the exceptions going to look like? The IRS really needs to give us more information before we can have this implemented, and September 30th seems really early.
That is
But
crazy early.
right, exactly. And so we haven't really seen a whole lot from the IRS on this, other than, they're working towards this. They know that this is something that President Trump wants to enact and have pushed out quickly. The IRS has been working to make sure like direct deposit is working correctly and things like that. And so they're trying to modernize and trying to digitize a lot of information, provide more information on their online accounts. So they're encouraging taxpayers to create online accounts that they can securely communicate. So it's just one of those areas where we hope that they will be given additional time, but we want all of our clients to be aware of it, that if you don't have an online account now, it may be worth going through that process, because it is a process where you have to verify your identity, have your driver's license picture,
You have to
a
send blood
selfie
type
taken.
samples in.
Right, exactly.
There's eye
exactly.
retina scans. I mean, it's actually very secure, and surprisingly enough, I find it very easy to use.
Yes, that's where I think that the pain on the front end of getting it set up
Is
was
worth it.
worth it once you actually get in and start seeing what they're trying to do there to make it a little bit easier. I will say that I have had several clients that have gotten text messages or emails from the IRS. Those are still scams.
Yeah.
Don't click the links, don't do the things, reach out to us if you've received, anything like that, because they are still sending letters and things like that. But this online account is supposed to be kind of their next version of trying to get into this century to make it easier to have communication with the IRS.
Yeah, if you're behind on your taxes, they will send you a letter in the mail still. So please do not believe the text messages.
There's just a couple of things. Anybody who lives in the state of Florida and did homeschooling when they went to all digital payments knows that it did not work out well. And it caused a lot of issues for a lot of people, especially because there was oftentimes bank fees in charge, and there was a lot of problems kind of related to the service around kind of automating these checks. So kind of as kind of an advocate for taxpayers, I'm really kind of worried about the automation of payments. And on the other side, we know that the IRS has been hacked before, and they're notoriously one of the lowest skilled from a technology perspective. Like when they go through and do those audits by the GOA about, Office of Accountability as to, how they protect your data, they're trying, but just because they make it hard for you to get in doesn't mean they make it hard for people to get your information out, right? And so I, as just kind of a living consumer, am kind of wondering what's going to happen if the IRS gets hacked again, like it happened a few years ago, I believe, and all these people's information kind of gets released. Who's going to be responsible for any damages going out there? More and more, you need to be thinking about, kind of identity insurance, or how it is that you're going to protect yourself as all of our information kind of gets culminated in different locations.
With all that being said, we still recommend that you get these online accounts set up and get bank accounts if you don't have them and you're currently using paper checks, because we do feel like this is coming. So again, this is just kind of informational for you guys to make sure you know that it's coming down the pike. So with all that, we're kind of at the questions point of our show here. If you have any, please email them to us at OBBBA@saltmarshadvisors.com. Again, we are happy to present to you here today. Hopefully this has been helpful. We will have several more coming up, and we're going to just try to unwind what information is out there versus what information we're actually seeing in the bill. As you know, there have been several iterations, proposals. It's gone through the Senate, the House, and then there was a final. I had to read up on my executive legislature knowledge myself to find out exactly how that process worked. It's very interesting if y'all have spare time this weekend to check it out. But nonetheless, point being is there were several proposals on this bill, and so it is confusing. It's very confusing even for us. And so if you've read something and you're not sure, you're unclear, you don't know how it affects you personally, please hit us up at this email address. We will address it either personally to you. We'll give you a call, an email, or we will address it in a future webinar. We would also love to hear from you what you guys want to hear about in that next webinar. Cole is telling me we're absolutely going to hit how a bill becomes a law. And so tune in for that. But if there's anything else, please hit us up. We would love to make sure we're addressing your specific comments. So thank you guys so much for your time today, and hope you all enjoyed it. Thanks, Stacy and Cole. You guys are awesome as always, and more to come soon, guys. Thanks.
Thanks, guys.
Thanks.